Hi everyone, welcome to our webinar. This is the second time we're doing this webinar because we had a great response yesterday. And first off, I hope everybody's staying healthy. We are doing everything that we can to curb the spread by observing the stay-at-home order. And we know that these are unprecedented times. Owning a small business is stressful, and it's stressful in the best of times, and particularly so now as things are changing so rapidly around us. So as the CARES Act was passed into law less than a week ago, I think it was last Thursday, we have dug in and we've tried our best to understand everything that is going to be affecting our clients, who are primarily small business owners and self-employed people. And so this webinar is for you. It is for the small business owner, the self-employed person. So it's not intended for individuals, and we're not going to be discussing the individual provisions in the Act, like the stimulus payments and the other individual provisions at this time. Except for we will be delving into some information later in the webinar about the unemployment provisions, but as they relate to small business owners and self-employed people, that is a nice provision in the Act that states are able to offer unemployment benefits to self-employed people at this time, which is new. So we've allotted an hour and a half to this. It may not take that long. It didn't yesterday, but we will jump right in after a couple of housekeeping items. We're going to have a Q&A session at the end. So if you have questions, please do type them in the chat box. And if we don't get to them during the webinar, we will get to them after. And hopefully it'll be something that I can answer. If it's not, I will do the research and get back with you. We had a couple of those yesterday, and I learned some new things that I will be talking about here today. So please be gentle with us. Remember, this was just passed into law last week, so we pulled this together very, very quickly. And secondly, I have to go over the disclaimer. This is no part of this presentation, including the slides, are to be construed as legal or tax advice. This bill is very, very complicated. There are some unique things in here, tax-wise, financial-wise, so please reach out to your lender, your legal counsel, your financial or tax planner for more information and planning for your particular situation, because it does affect everybody differently. So we will jump right in. Okay, so by far, I believe that the best provision in this CARES Act, which is also called HR 748, is the Payroll Protection Program. And the idea behind this, the intent behind it, is to keep small to keep workers employed. It's to help small employers keep their workers working. And let's see, go to the next slide. There we go. So Payroll Protection Program, what, when, and how? This is a loan program. Now, part of it may be forgivable, and we will talk about that later, but this is a loan program to help employers with fewer than 500 employees keep workers employed or to rehire them. Again, loans will be forgiven if certain conditions are met, but it's important that you know what those conditions are. Loans can be made under this program until June the 30th. And the loans will be made by the SBA preferred lenders. So ask your bank or your credit union if they are participating. When we gave this webinar yesterday, we were having a hard time finding lenders that understood what was going on. And again, that is because this is very, very new. SBA has not finalized the loan application process. And so that has to be done before the lenders, the banks, can do their part. So be patient with them. I did this afternoon just get an email from my bank that explained that they will be reaching out again with the process. So they are coming on board. It's just that they are overwhelmed as well with all the new stuff. Now, I did mention that loans can be made under this program until June the 30th. However, as I understand it, the funds allocated to this program are limited. I mean, it's a big sum of money, but it is limited. And once those funds are gone, they're gone. So it appears to me that time would be of the essence. Now, I'm not trying to create a panic or anything, but yeah, you want to get your documents in order, have your ducks in a row, so you can avail yourself of this program when it comes online. So for the purposes of this section, I wanted to define what payroll costs are, because this loan program is going to be based on payroll costs. So the payroll costs that we're going to be talking about are the sum of salary, wages, commissions, cash tips, vacation, parental, family, medical, or sick leave, employer cost of group health insurance, employer portion of retirement benefits, Texas unemployment tax or the state, whatever state or local tax that you have, and net income from self-employment of a sole proprietor. Now, we got a question yesterday. Are payments to 1099 miscellaneous contractors or your subcontractors, are those payments included in here? Now, at my first glance, I said no, but I went back and I read the act again, and just for your knowledge, you can read the full text of the act if you want to go out to congress.gov and look up HR 748. It's out there for everybody to read. It's, as those things are, it's a little difficult to understand and decipher. So the reason that I would say no is because if you think about this, if you're including the 1099 payments in your payroll cost and you're getting a loan based on that information, but then that person is self-employed. If they get a 1099 miscellaneous, they're considered self-employed. So now they too are using that income in their calculation. And so it seems to me like that would be double dipping. However, the wording of the act says that payments to a sole proprietor or an independent contractor would be included. So again, this is where more guidance is probably going to be issued, I would imagine. And it's going to come down to what your lender says, because the banks are going to be the ones having the last say on this, as they're the ones that are going to be lending the funds. Okay. Now, to calculate the amount of the loan that you would be eligible for, you're going to take those monthly payroll costs for the past year that we just talked about, the sum of those payments. Now, when it says the past year, what that means is, let's say that on April 6th, which is hopefully when these funds are going to be opening up and being made available. So let's say that you apply for your loan, then your look back period, your last year, is going to be from April 1st of 2019 to March 31st of 2020. And then you're going to take the average monthly payroll costs and multiply that by 2.5. So essentially your loan amount is going to be 2.5 times your average monthly payroll. And again, when we use that term payroll loosely, because it does not just include salary and wages, it includes all of those things that we just talked about in the last slide. Now, if you are a seasonal employer, so a lot of our lawn care people, pool maintenance people, those are seasonal employers. So you would take your average monthly payroll costs from February 15th of 19 to June 30th of 19. You would average that out by the month and then multiply by 2.5 and again get your loan amount. So let's just get into the math of this, and it's, you know, this is where it gets fun. So we're going to say that you're a seasonal employer, and say that you look back at your records and your payroll costs, including all of those things that we already talked about, for February 15th of 19 to June 30th of 19. Now that's a 19-week period in there. I counted it because I wanted to make sure. Your costs, let's say your costs were $76,000. So now you're going to take $76,000 divided by 19 to get your weekly costs, which that would equal $4,000. And then you're going to take $4,000 times 4 1/3, because there's 4 1/3 weeks in a month. So now your average cost per month equals $17,200. Now we said that you can take 2.5 times that amount. So if you multiply 17,200 by 2.5, you get 43,000. And so that is the loan amount that you would be eligible for. If you are a new business, you can still apply for this program as long as you were in business as of December 31st of 2019. And so you would take your average monthly payroll costs for January and February of this year and multiply those by 2.5, and that would be your eligible loan amount. So what is not included in payroll costs for this section? Wages or self-employment income in excess of 100,000 per person. So let's talk about that for a minute. Included in the payroll cost was self-employment income. So if you're a self-employed person, you would file a Schedule C with your tax return. So we're talking about the number at the bottom of the Schedule C. That's your self-employment income. So if that exceeds $100,000, you have to put that cap on it. You say that your income was $100,000. And then let's see, if you're an S corporation shareholder and your wages are more than $100,000, you would put that cap on it as well. So you're now, when you do your calculation, you're going to take all of your employees at their rates of pay, but yours is going to be in here at just 100,000 before you divide by the monthly, figure out what the monthly payroll cost is. Okay, also not included here is wages paid, wages or family leave paid as a result of the Families First Coronavirus Response Act. So if you'll remember, I guess it's been 2 weeks ago now, they passed the Families First Coronavirus Response Act, and this was, it gave some provisions for if an employee gets sick, or an employee's family member is sick, or if they have a child that their daycare provider isn't working, so they have to stay home to take care of their child, then employers would be responsible for paying up to 12 weeks of paid leave. And then they would take that as a credit against payroll tax. So those wages, because you're going to get a payroll tax credit for those wages, they would not be included in this calculation. And then also to be included in your payroll cost calculation, your employee has to reside in the US. So the allowable uses of the loan proceeds. Now this is in order for the loan to be forgiven. Your allowable uses are during an 8-week period starting on the date of the loan would be your payroll costs that we've already talked about, additional payroll costs for compensating tipped employees. So if you're a restaurant owner and you pay your servers $2.13 an hour, you would add into those payroll costs the amount needed to raise their wage from $2.13 to minimum wage. Also, rent would be included, would be an allowable use of the funds. Interest on mortgage obligations. Now, this is secured real estate. The interest on the mortgage obligations that we're talking about is secured real estate. And any other debt obligations that were incurred before February 15th, 2020. So you can't go out now, take out a new loan and use these loan funds to pay for the interest on that. And again, I believe this too is referring to secured debt. I do not believe it is referring to credit card debt. And then utilities would be the last one. So basically, if we break it down, we have 4 items here that you could use those loan proceeds for and expect for your loan to be forgiven. It would be all payroll costs that we talked about, rent, interest, and utilities. Okay, so the loan forgiveness. So now we've taken out this loan. We know our loan amount is 2.5 times your payroll cost. So we go and we get that loan. Now, the best case scenario is that we get that loan forgiven and we don't have to pay it back, because that would act like a grant, and that's, you know, that's going to help us out a lot. So this is what has to happen in order for you to get forgiveness of that loan. There is an 8-week period, and I tried to put a little graphic in here, but you know, I'm not that smart. So the loan origination date, the date that you sign your loan paperwork, until 8 weeks later, you can use the funds to pay for allowable uses, the 4 allowable uses that we just talked about: payroll, rent, utilities, and interest. At the end of that 8 weeks, whatever is remaining and whatever amount that you did not get forgiven because of any reduction, which we're about to talk about, that remaining balance, whatever's left, has to be paid back. And because this is a loan program, remember. And your lender will ask for documentation that you use the loan proceeds for the allowable uses. So document. I'm telling people, get you a if you're approved for these funds, get a separate bank account, put those funds in there, and use the loan proceeds for allowable uses and get your loan forgiven. So let's talk about the reduction of loan forgiveness. Let's go to the next slide. Think about hour cuts here. Now, if your workforce is reduced, or if your wages are reduced, then part of your loan may not be forgiven, even if you used it for allowable purposes. So here's the scoop on that. So there is a look back period, and you're going to see how many average monthly employees that you had during that look back period. And that look back period is at the discretion of the borrower. So this is where you can decide how you want to do this, and you can do a little planning here to see how it's going to work out best for you. The look back period is either going to be February 15th of 2019 to June 30th of 2019, or January 1st of 2020 to February 29th of 2020. So you see how many average monthly employees that you had in that look back period. And then you see how many average monthly employees you had during the 8-week period starting on the origination date of your loan and going forward for that 8 weeks. And you divide that number by the number in your look back period, and you get a quotient. So, well, I think we have an example slide in here coming up, but let's go over the rest of this first. So that's one way that your loan would be reduced, is if your workforce is reduced, then your loan is going to be, your forgiveness is going to be reduced. And the other way that you're say you had to cut hours or you had to cut rates of pay in order to keep people on the payroll. And if you cut wages by more than 25%, then your loan forgiveness is going to be reduced. So let's go to the next slide and look at, I think, an example. Okay, here we go with the math again. So let's just say that your, look at the little chart there at the bottom. Let's just say that your allowable costs for payroll for the 8-week period, I'm sorry, let's back up. Your allowable costs for those 4 items during the 8-week period, payroll, rent, utilities, and interest, let's say that equaled $100,000. During the 8-week period, you had 10 employees, but previously during your look back period, you had 15 employees. So your quotient there is the 10 divided by the 15, which gives you 0.67 or 67%. So now you're going to multiply your allowable costs during the 8 weeks times that quotient of 67%, and you're going to get an allowable reduction of $66,666.67. So your reduction is going to be that $33,000 there. So even if you used all of your loan proceeds for allowable costs, for the 4 allowable costs, but your workforce was reduced during the 8-week period, you're still going to have a reduction in your forgiveness of your loan. And that means at the end of that loan period, you would still have $33,000 that you needed to pay back. Okay. Brandon, can you move it? Yeah, there we go. Okay, so that's one way. Now the second method would be a reduction related to salary and wages. So again, that would be if your wages per employee are reduced by more than 25% during the 8-week period as compared to the previous quarter. So if your 8-week period starts in April, your previous quarter is going to be January through March of 2020, and you're going to look on a per employee basis. If their salary or wages falls by more than 25%, then that amount by which their wages or salary falls is going to be a reduction in your loan forgiveness. And I will update this example as more information is available on that. Okay, now the good news, the nice little silver lining in this whole scenario is that you can be exempt from that reduction in loan forgiveness if you bring back up your workforce by June the 30th. So if you've laid off employees or you're going to lay off employees between February 15th and to April 26th, but you rehire those employees and bring them back to their previous levels of wages, you could be exempt from the reduction in the loan forgiveness. So again, there's more guidance surely to come out on this, and I will follow up with anybody that's on this webinar about that. And this is a fun little tidbit. If a portion or all of your loan is forgiven under the Paycheck Protection Program, it will be, the amount forgiven will be taxed on your 2020 tax return. In other words, there's no double dipping. And if your loan is not forgiven, then it's treated as any other loan on your balance sheet. Okay, so to the extent that the loan is used for allowable purposes and to the extent that it is not reduced for a reduction in workforce, this loan is like a grant. So if you meet all of the qualifications, this loan is really free money. I mean, you know, most of us think that free money never happens, but if you meet the conditions, this loan can be a grant. However, to the extent that you use it for other expenses that are not allowable, or to the extent that you reduce your workforce and it's you have a reduction in the forgiveness, then you will be personally liable for repayment and on the remaining balance. And the maturity of it is a maximum of 10 years. I believe that's going to be subject to what the lender says. And then the interest rate is not to exceed 4%. Now here's a nice little tidbit on this one. The payments on any remaining balance would be deferred for 6 months. And at the discretion of the lender, it could be deferred for up to 12 months. And there is no penalty for prepayment. Okay, so the loan application now, how do you get this money? So if you're a self-employed individual, let me say my little disclaimer first. This list is not comprehensive, and depending on your lender, they may ask for items that are not on this list, but these are some of the things that I would have ready, just because these are generally the things that are asked for when you apply for a loan, and the things that are likely going to be asked for. For self-employed individuals, so those who file a Schedule C, you would need to have Forms 1099 miscellaneous that you have received for 2019. You would need to have payroll tax filings. So if you are an employer, if you're a self-employed individual and you have no employees, then this wouldn't apply. But if you have employees, you would need to have your payroll tax filings for the last 4 quarters, your federal unemployment tax filing, your W-2, your state unemployment tax filings. If you employ others, you're going to need your payroll registers for your look back period. So again, that look back period, if you are a regular employee, would be April 1st of last year to March 31st of this year. If you are a seasonal employer, it would be February 15th of last year to June 30th of last year. And if you are a new employer, it would be January and February of this year. You're going to need the proof of income and expenses for the sole proprietorship. So your lender could potentially ask for bank statements or a financial statement. And here is where if you have a good software for your accounting, like Xero, that could be very helpful in getting a profit and loss and balance sheet quickly. And they will potentially ask you for a Schedule C for last year, for 2019. So again, if you're a self-employed individual, you have not done your Schedule C yet for 2019, you may want to get that done. Although I'm gonna put up a little caveat in there. Your tax professional is probably overwhelmed right now, so be patient with them. And then also for a small business owner, so if you file an 1120, an 1120S, or a 1065, then you're going to want all of your payroll registers for your look back period, all of your payroll tax filings for the last 4 quarters, and documents verifying your mortgage or lease obligations and utility payments. And if you're a partner in a partnership, and if your business files a 1065, you're probably going to want to have your K-1 available, showing your guaranteed payments or your self-employment income. Okay, so that was the Paycheck Protection Program. Now, I know that was a lot of information thrown at you. It took us days and days to decipher all of that information, and I'm throwing it all to you in 15 or 20 minutes. So please reach out if you need assistance figuring out what is going to qualify, what doesn't. If you need help figuring all of this out, reach out to us. Now, moving on. We're going to talk about the economic injury disaster loans for just a minute. And this is a separate program. This is different than the Paycheck Protection Program. They both fall under the CARES Act, but it is a separate program. This is the, I'm sure that you've heard on the news that the government is making loans available that are supposed to be easy to get through the SBA. That's what this is. So you can apply online at www.sba.gov, and there are loans available at terms up to 30 years and at 3.75% interest. So avail yourself of that if you have to. And now another nice little thing there is that if you apply for one of these economic injury disaster loans, or EIDLs, you could be eligible for an advance of up to $10,000 if you have immediate costs that you're struggling to pay. So if you're struggling to pay your payroll, your rent or your mortgage, the increased cost of materials due to interrupted supply chain, or repaying obligations that you can't pay because of your revenue losses, then you know, you can apply for this advance. And they're supposed to make this advance money available very, very quickly, like days. I think they said like 3 days you're supposed to be able to get this money. And then the good news here is that even if you don't end up getting approved for the loan, you don't have to pay this money back. So, you know, I'm sure there are some qualifications that are going to be there. I'm sure you're going to have to prove that you're in a situation where you can't pay your immediate costs. That's what this is for, to pay immediate costs of business. So if necessary, again, go this route. SBA.gov, I'm sure, is weighed down right now. So again, you're probably going to have to be patient, but it's there. Okay, do not fall prey to scammers. Right now, I cannot stress this enough. In any situation like this, scammers just come out of the woodwork. This is no exception. There's people out there online, if you Google these programs, there's people out there promising they can get money for you. They're promising all kinds of things. And you know, they're out there to get you. So as professionals, yes, we probably are going to have to charge you for services, but be sure you know fees up front. Ask a professional that you know or somebody that comes recommended. Don't just do a Google search on these programs and find a scammer that's out there. Know that there is a limit that will be established by the SBA on the amount that a professional is allowed to charge you for assistance with this program. I don't think the SBA has announced it yet on the Paycheck Protection Program, but there is an SBA fee disclosure form related to the EIDL program, the one that we just talked about. And for that program, there is a maximum of $2,500 that a professional could charge. So again, don't let somebody scam you. Let's see. I think we're over. I'm done with my part. I'm going to turn it over now to Caitlin, and take it away, Caitlin.
Thank you. So today the two provisions that I'm going to talk about are the payroll tax credit and the payroll tax delay. So while the credit and the delay can be really helpful for your business, if your business does receive one of the SBA loans that we just talked about, neither the credit or the delay that I'm going to talk about will apply to you. So these are separate things that you can take advantage of. Also, remember as we go through this that both the credit and the delay apply only to the employer portion of Social Security tax. So that does mean that you still are responsible for paying in the 1.45% of Medicare tax, but both of these things apply to Social Security tax. So first, let's get into the delay, the payroll tax delay or deferral. So this delay or deferral went into effect March 27th and will go all the way through the end of the year. So any employer Social Security tax that you would normally be responsible for paying in will now be delayed. You do not have to pay that in this year. But since it is a delay or a deferral, it is still due. So the way that works is half of that liability will be due December 31st, 2021. And the remaining half will be due on December 31st, 2022. Again, you still are responsible for the Medicare tax. That is not delayed. But this could be really helpful in freeing up some funds for those essential business expenses that we have. So we did reach out to Gusto before this, and they still don't have any information about this. So if you use a payroll company like ADP or Gusto, who automatically take out and pay your payroll tax on your behalf, be sure to reach out to them to make sure that they don't pay these taxes on your behalf if you would like to take advantage of either the delay or the credit. It is important to note, though, that this means virtually all Q1 payroll taxes are still due, except those collected March 27th through the 31st. And as of today, the quarterly 941 is still due on April 30th, 2020. So next is the employee retention payroll tax credit. So this one is very difficult to understand, so I'm going to do my best to explain it. Unlike the delay, the credit has some requirements that do have to be met. So these are: A, your business was either suspended or partially suspended due to government orders associated with COVID-19, or B, your business faced a significant decline in gross receipts due to the pandemic. Now, a significant decline means is referring to the first calendar quarter in 2020, where an employer's gross receipts are 50% less than the corresponding calendar quarter in 2019. So one or the other, your business has to meet those requirements. Now, before we move on, there are additional requirements for employers with more than 100 employees, but since we primarily work with small businesses, for the sake of this webinar, we'll be focusing on businesses with fewer than 100 employees and the requirements for those. Also, we are still unclear on if this credit applies only to full-time workers in your business, or if it applies to all employees for your small business. But we will send updates when that information becomes available. So this credit, going back to the slide, this credit amount is equal to 50% of the qualified wages of an employee up to $10,000. And if this credit amount exceeds the employer's liability, the excess will be refundable. And this credit can be taken in conjunction with the payroll tax delay, so that's a nice perk. And for self-employed persons, you can adjust your estimated tax payments to account for the deferral or credit without being penalized. So we'll see a little bit more about how this credit works in the example we'll consider next, but it's important to remember that this credit is limited by the amount of, again, Social Security tax on all employees. And as a side note, this credit went into effect on March 12th. So part of the first quarter's tax can be taken as a credit if this applies to you, going back to the requirements that you have to meet. So let's take a look at an example. So let's say you have one employee whose rate of pay is $15 an hour and his total Q2 wages were $7,800. And additionally, you paid him $500 per month for his healthcare, because healthcare costs do qualify for this credit. So for Q2 of 2020, your revenue dropped by 50% compared to Q2 of 2019. So you would be eligible to take a payroll tax credit as follows. So you've got your $7,800 of wages and $1,500 for healthcare costs. That's $9,300. So 50% of that would be $4,650. But again, this is limited to the amount of Social Security tax on all employees for the quarter. So Social Security tax of 6.2% on that amount, on that wage, is $483.60. So the maximum credit you could take is $483.60. So it's not as great as it looks on first glance, but it is still something. And this is an example of only if you had one employee. So hopefully this makes sense. Again, you can take both the credit and the delay, and you don't qualify for either if you have applied for the SBA loan. So if you have any questions, we'll answer them after this. But for now, we'll move on and let's hear Brandon talk about the unemployment benefits in the CARES Act.
All right, thank you. So yes, unemployment benefits and the CARES Act. So in this little part of our presentation, we're going to be talking about what the government is actually doing, as well as what the state is offering for unemployment. The reason we're covering this, it could be of benefit to many of our clients, but also to, as business owners, we definitely care about employees, and it definitely hurts us if we're having to let some of them go. So what can we do to help ease this, helping them to understand, educate them, as well as being educated ourselves about some of the provisions of the CARES Act. By no means does it make it any easier necessarily, but again, just having this knowledge may help during this difficult time for everyone. What we're going to look at first is actually what the Texas Workforce Commission has to say about the CARES Act. It's pretty straightforward. As of actually this morning as well, the TWC says on their website it is currently unable to address the implementation of HR 748, aka the CARES Act. On the employee side of the website, they're a little bit nicer, they're a little bit more reassuring. Basically, they're saying we are upgrading our system to adapt to the new legislation. And they also say if you attempt to access the system or call prior to receiving any notification, we will not be able to assist you. So at the moment, we are not able to hear anything officially from the TWC to know how they're going to implement things. But we do know, of course, what the CARES Act says, so we can at least review that. But I thought it'd be beneficial, again, just to see what the TWC says. That having been said, let's say you did have to lay off an employee prior to the CARES Act, and they were not eligible for unemployment at that point in time. The website does say, Texas Workforce Commission now says, if you apply for unemployment benefits but lack the necessary wages to qualify, no action is needed. We will determine if you qualify under the new bill and notify you by mail or electronic correspondence of your eligibility. So again, if you or employee did not qualify before the CARES Act came out, they still have your application on the file, so they will reach back out to you as soon as they get it all figured out. And just like you heard from Cindy and Caitlin, a lot of this is hurry up and understand it, and now hurry up and wait, hurry up and collect your documents and wait some more. This bill went into effect on Friday. Then over the weekend, everyone's trying to understand it. And now we're waiting on guidance from all sorts of different federal departments, for example, the Treasury Department, the Small Business Administration. So Congress writes the bill, everyone then has to figure out, the government has to figure out how to implement it. And then the banks, your tax professionals, everyone is now figuring out how to make it all work. So again, it's going to be a lot of that going on. What I did like on the Workforce Commission website, they did have an example of a frequently asked question, because in normal circumstances, when you have someone who you let go, again, under normal pre-pandemic situations, if you let them go, they would file an unemployment claim, and then they would actually come back to you, the Workforce Commission would, and do what's called a chargeback. So the question is, if you've been ordered as a business to close your doors, lay off employees because you can't operate, would I have to pay for unemployment benefits for my employees? The Texas Labor Code says if you have to close because of an order from a government entity, so we're talking city, state, federal, you can ask for chargeback protection as an employer. Most likely, one would hope that as they get these in, they're understanding it's because of the pandemic, because of COVID-19. So we probably wouldn't see that, but it's good for you to be aware in case you get some sort of chargeback notice from the state, that if it's happening because of COVID-19, to be able to ask for that protection. In order to ask for that, though, we would recommend you get a copy, and it's available online, a copy of the order from the city, the state, federal government, whatever applies to you, to be able to prove, say, I had to close because of this order. One of the other things it's good to remember is, again, for the benefit of our employees, the state has waived the 1 week waiting period for benefits, so it goes into effect pretty much immediately upon approval. So that's something, a bit of a silver lining. Also, as is noted on the slide, Texas is encouraging employers to consider the shared work program. Now, what exactly is that? We're basically talking about partial unemployment. So let's say you're still able to operate, but obviously you're not able to keep everyone busy for 40 hours a week, or you're trying to not lay everyone off. The shared work program would basically allow your employees to receive benefits. So there's a parameters, of course, for this. If you have to reduce employees' hours between 10 and 40% of their normal 40-hour work week, you might be eligible to participate in this. If you'd like some more information, we can provide that. Again, we're also going to have to wait on the state to provide some more details, but you do have to create a plan in order to make this work that has to be approved by the TWC. But they're really urging employers to think about this option, so that way the state, you're able to still keep your employees, hopefully be able to function as a business, and the state doesn't have to provide as much unemployment benefits. So it's kind of a win-win for both. The fourth point, if you have to actually close everything down, if you want to try to do just a few more things to help your employees, the TWC does have a system called the mass claim filing. And basically this would allow you to be able to help your employees file for unemployment. It's basically just a big batch of data that goes to the state, and it helps to streamline the process. So again, it's something that unfortunately if you have to go that route, you might be able to do to help your employees out. Looking now at the CARES Act. So now we're switching from what's happening at the state level to the federal level. Most of us have heard about some of these benefits on the news, but again, we're just going to review them. There's three key elements to the unemployment part of the CARES Act. There is the federal pandemic unemployment compensation, the pandemic emergency unemployment compensation, and the pandemic unemployment assistance program. So a lot of words, all sorts of different things, and even funnier acronyms. I'll leave you to interpret them at your whim. If you just want to have a fun game to play tonight, try to guess what these acronyms are and how they're pronounced. But all three of these are separate parts of the CARES Act, and all three of them work together. They do work in tandem, but again, they're also separate. So we're going to talk about each one point by point. First off is the federal pandemic unemployment compensation. We put the acronyms there because as you're reading online, we know you're looking at a whole bunch of different resources. You're going to see some of these acronyms, you're going to see different variations, so we try to include them just as an education point. The pandemic unemployment compensation basically is the part where anyone receiving unemployment receives an additional $600 a week from the federal government. So this is in effect from the date the bill was signed, which was March 27th, through July 31st. Again, the key point, anyone on unemployment during that time period receives an additional $600 from the federal government. So let's put that in layman's terms. What the government's trying to do is they're saying, look, everyone's just been obliterated. We're going to try to give each person on unemployment, we're going to try to get them at least 100% of their wages, pre-pandemic. They're trying to get us back to that point. So let's say you were full-time before you were laid off. Now you're on unemployment with the TWC. You're getting your benefits from the state. you're going to get an additional $600 again from the government. We don't know yet how the state's going to handle it. It can either come with the state's check or as a separate deposit from the federal government, but it will happen at the same time. So again, a provision that's being made by the government. The next one is the Pandemic Emergency Unemployment Compensation. And when we make these slides available, you notice we did our best to include the pertinent sections of the CARES Act. So if you just are looking for something to do as you're experiencing cabin fever, you're more than welcome to read over these as well and benefit from that. Basically what this says, so when it comes to unemployment, the Texas Workforce Commission, along with most states, basically gives everyone 26 weeks of unemployment. Now, once that's over, the state doesn't have anything else to offer. What the government is doing with this program is saying, if after 26 weeks you're still unemployed, where you're going to receive an additional 13 weeks of unemployment benefits. So the maximum amount of employment benefits, the maximum number of weeks is 39. Now, currently, the way that this provision is set up, the law states that you will receive this 13 additional weeks if you're looking for work. So why does it say that? When we think about the typical setup for unemployment, you file for it with the TWC and they say, we need you to be actively looking for work, right? They check in on you to make sure that you're doing those things. The idea is for you to get back to work as quickly as possible. Obviously, no one can do that right now. So currently the state has waived that need to be able to go, the requirement to go look for work in order to get unemployment benefits. So what this provision is in place for is the government saying, hopefully in a couple months' time, everything will be getting back to quote unquote normal. So the idea is you're going to be out looking for work. We're going to give you an extra 13 weeks in case you're still struggling to get work back because of the pandemic. And of course, they're saying the idea is you're already looking for work, you just need a little bit more of a buffer. Of course, the caveat is if we're still dealing with the pandemic after your 26 weeks has been exhausted during that 13 weeks, if we're still dealing with COVID-19, they're going to waive that requirement and go ahead and give you those 13 weeks. So hopefully we won't be dealing with the pandemic by that point in time.
Hey, Brandon, can I ask something
Yes.
on that real quickly?
Yeah, of course.
Okay, I don't know, some of you were around and business owners and such back during the Great Recession in 2008 and 2009. And you might remember that the federal government did something similar. They extended the unemployment benefits by 13 weeks, but they did it at a greatly reduced amount. Do you know, Brandon, if that is going to be the case here, or is that something we have to wait and see?
There is nothing in the law that I saw that indicates that they're going to reduce it.
Okay.
It won't, of course, include the 600 because that ends July
Right.
31st, unless they choose to
Right.
extend it, but it'll be whatever the state was already providing just for an
Okay.
additional 13 weeks.
Okay, thanks.
Yeah, barring some additional legislation or
Right,
anything like that.
of course.
Yeah. Or them saying, oh, wait, no, that's not what we meant. We meant this.
Yeah.
So, but great question. Thank you for highlighting that. Looking now at Section 2102 of the CARES Act, this created the Pandemic Unemployment Assistance Program. So perhaps you've heard about this on the news. Basically what this is doing is creating unemployment benefits for a whole host of people that normally do not receive unemployment benefits. So as you see, there is a definition there. Per the definition, this is providing unemployment benefits to individuals who are not currently eligible, such as self-employed individuals, those seeking part-time employment, those who don't have enough of a work history or otherwise would just generally not be qualified for regular unemployment compensation. So who does that include? Again, self-employed people, as it mentioned, independent contractors, freelancers, gig workers. For example, photographers, we think about even DJs. And again, those who maybe just don't have long enough work history to normally qualify. Now, there are, of course, some parameters. This isn't just a free-for-all. Basically, you have to be able to prove that perhaps you, someone in your household is dealing with COVID-19, or you've lost your job because of COVID-19 ramifications, for example, shutdown orders, things like that. Perhaps you've become the sole breadwinner because the breadwinner in your family unfortunately passed away because of COVID-19. Even if your children, let's say you in theory are still able to work, but your children can't go to school because of shutdown orders. I just saw San Antonio extended that through May 4th. So you have to stay home to take care of your children because you can't get, any sort of extra care. You could be eligible to receive this unemployment assistance. But so they try to make it as broad as they could, but again, there are still some parameters. What is interesting about this, as you notice on this slide, the duration of this, it actually goes back to January 27th and runs through December 31st of this year. Basically what they're saying is we understand not all of the people who are not eligible to apply for unemployment benefits, they may have been affected a whole lot sooner than March 27th. So the government's saying what we're going to do then is when you file, again, we're not exactly sure how they're going to figure all this out, but basically if you can prove you're unemployed before March 27th, basically that window from January through March, you could potentially receive retroactive benefits from this point in time. So again, a provision to be able to help people who normally would not be able to receive these provisions. So the next question is, how exactly is that going to be calculated? The section 2102 explains how they're going to do this. And what they do is they quote a previous part of the tax code. It's in the Code of Federal Regulations. And what you'll notice on this slide is self-employment income will be treated as wages. So again, we think about a normal situation. You go to the TWC, and if you're working for an employer, someone, you have a W-2, you have wages to point at. Obviously, as a self-employed person, you don't always have that. So they're going to treat your income as wages, and you'll receive benefits according to those wages, according to the structure the TWC has in place or will set in place for self-employed. We don't know how they're going to handle that. Currently, the maximum benefit allowed in Texas for unemployment is $521 a week. So that's the max you could potentially receive from the state. If you have not filed, they'll get that self-employment income from your tax return. If you don't have a tax return filed for 2019, they're going to perform, and I know this sounds like, they're just going to pull some numbers out of the air. Somewhere out there, they do have a calculation. They're going to make a calculation and provide that to you. But let's say you weren't making that much money. The program says what they will do is they will take the state's average benefit for unemployment, which in Texas, the minimum is $69 a week, the max is $521, so the average is $295. They're going to see if you qualify for that $295. If you make less than half of the average state benefit, you will then receive 50% of the state average amount. So all of that to say, the short version is, if you don't make a whole lot of money, you can plan to expect about $147 a week. In addition, through July 31st, $600 a week from the federal government. And so that takes care of that.
Something there?
Please, yes, absolutely.
Okay, so so this is interesting to me because, as self-employed people, traditionally we have tried to help our self-employed individuals. We have planned for them to pay the least tax legally possible. And to do that, we calculate some certain things such as mileage and home office expense and depreciation, and we max out that depreciation. So if they've bought equipment in 2019, then we probably took, and if we've already done the tax return, we probably took the maximum allowable depreciation to bring that taxable income down. So now I'm wondering, and this is of course a question again that we're going to need guidance on, but I'm wondering if the self-employment that they're going to be, the unemployment that they're going to be allowed is going to be based on that bottom line after all of those non-cash expenses like depreciation have been taken into consideration. So if so, that is going to be a very nice provision that the you know, that the program is going to give them the average weekly benefit plus the $600.
Right, exactly. And so, and I appreciate you saying that, Cindy. I didn't say it, I have it on the slide, but they take that self-employment income based off the net income reported on the tax
The
return.
net income.
So like you said, we
Okay.
try to
Yeah.
maximize, we try to make sure, you know, without going crazy, we do try to make sure to get that number as low as possible using all the tools available. And so, yeah, this is an excellent provision that they're doing to use that average.
Right.
Yeah. So, well, that wraps up this section on employment. Of course, we'll be happy to answer questions at the end as best as we can. Now we'll turn it back over to Cindy.
Okay, one thing that I missed earlier, this was based on a question, I don't have a slide about it. This was based on a question that came out yesterday. As part of the CARES Act also, if your business already has an SBA loan under Section 7A, you are eligible to have the payments, including principal and interest, deferred. Not deferred, I'm sorry. This is a subsidy from the SBA. They are subsidizing the payments for 6 months. Now, the wording in the act is that if you have that amount deferred, because the lenders can reach out to you and defer your payments. But my understanding is that if you choose to have your payments deferred, the lender is going to tack those payments on somewhere, either at the end of your loan or you know, raise your payment to account for the deferment. But if you don't have it deferred, it seems to me that the wording in the act is that you can have those payments subsidized, principal and interest, so completely forgiven for 6 months. So that's another thing. So if you have an SBA loan, talk to your tax professional first before you have those payments deferred. Talk to somebody first and see if that is the best course of action. And we will be doing some more research into the act to be able to help you with that. Now, you know, just as we wrap this up, we do want to say that, you know, unfortunately, this bill, while it seems simple on the face, you know, you're going to watch the news and all of these things sound fantastic, but it has some unique and complicated implications. And it requires a lot of research, ongoing research. So please know that we will be here to provide guidance as much as we can to help and support you and your business during these uncertain times. And to that end, we have reviewed our pricing policies and we're making some temporary changes. So through July 31st, subject to extension if this thing drags on, we're going to be offering a 15% discount on our hourly services connected to the CARES Act and tax provisions therein and financial planning. And also, if your business is struggling and you need our assistance but can't pay for it up front, we will figure out how to work it out. We will provide some flexible payment plans. And as always, we appreciate your referrals. In the meantime, guys, stay safe and stay healthy, protect your families, and power on. I did want to also kind of give my little Friday night halftime pep talk. You know, we know that these are unprecedented times for small business owners, and some of you made it through the Great Recession in 2008, 2009 with your business. And we think that this may be even more challenging yet. Some of you I've worked with for years, and some of you for a short time, and some of you I'm just getting to know. But you guys, as self-employed people and small business owners, you make up the backbone of the economy and the backbone of the community. So we need to all pull together and figure this thing out. You guys are fighters as small business owners. We are resilient people, and we're equal to this challenge. I've already seen some displays of ingenuity and people pulling together and rolling with the punches. So we're all in this together. Reach out to us, reach out to your other resources, pull together, think outside the box, reach out to your vendors and your customers and even your competitors, because there is knowledge as a group. You know, the more heads you put together, the more you can come up with, more ways to get through this. So keep on fighting. And thanks for attending our webinar. We will make this recording available on, I think we're going to have it on our website and maybe on YouTube as well.